In this video, I want to discuss strategy diversification. That's what Renaissance technologists did back in the day to gain 60% annualized return throughout 30 years with a Sharpe of 5 or 6. Okay, I'm quoting them. So, people are trying to find this one golden strategy that has to have all these parameters like high Sharpe, high annualized return. Okay, it should be worth deploying. It should be persistent across all regimes in the stock market. That's all bollocks. That's not usually how it goes. Okay, what real hedge fund does is a lot of mediocre but live proven strategies that are like 20 annualized return, 5 to 10% drawdown, perform well in a choppy environment or in a trendy environment, whatever. One of, not both of them. And another strategy for another asset, okay, preferably that is not correlated to the former one. Then third strategy that would perform better in the opposite environment. This way, they're gonna even each other out. That's gonna give you the Sharpe you're looking for, which is around in the high threes or fours or fives, while keeping and compounding returns, making consistent 50 or 60 or even 100% a year. That's doable only with strategy diversification. And that's what we're gonna cover in this video. I'll walk you through my strategies. I'll walk you through correlation metrics I use and other correlation metrics for making sure strategy are diversified enough, okay? Because you don't want to have the same strategy that have too many repeated trades together, okay? That just doubles your risk. And risk is what you want to minimize. I'll walk you through my live performance. I'll walk you through portfolio that I constructed with AI. I'll tell you how I used it in order to create and test the strategies. And we'll see how it performed for the last month. Spoiler, it's up 4% right now. And I'll tell you why you need to understand strategies in order to diversify strategies in the best possible way. Let's go. Okay, first I want to walk you through my AI dashboard, my cockpit, okay, the main core of developing systems, reviewing them, all my processes, okay, reviews with AI, for AI, reviewing from AI, okay, all of that. Because one of the biggest problems I found when using AI for development and research is the lack of understanding of what's happening. It's pretty hard to keep up with AI. Because, let's be honest, it can do a lot. So I created a cockpit. It has things that needs me, like a task tracker or something. Okay, I have it split by the project. I have type. If I need to make it a decision, okay. For example, run gate. Gate is a skill with me reviewing and making all the decisions, okay, for a thesis. For example, I have consolidation effort predicts breakout size. Okay, I'll need to run that. It's been sitting here for 11 days. Okay, then we have a recent changelog. It also helps understand me what's happening with the project, with the strategies. Okay, and then we have quick actions. Like if I want to run a new alpha, like a new understanding idea from AI, not from me, or if I want to implement something with my idea, run a strategy health check, portfolio level overview, whatever. There is a lot. And also I have roadmap and other things that may require my attention, but I'm not gonna go through all of it. And let me show you strategies that I have run live right now. If I go to portfolio constructor, you can see equity curve of combined strategies. 17% drawdown and 67% annualized return. Sharpe is almost 2. Pretty nice. Ignore this, these are more advanced stuff. If you look at the equity curve, that's basically what you want to see. Straight up and to the right. Okay? Pretty consistent. Reason why I have this so smooth and consistent is because I use different time frames. I exploit Hedge in different assets. For example, here I use Nasdaq and Bitcoin strategies. I use different regimes, etc. If I add strategy like mean reversion for euro and Swiss franc for 15 minutes, look what happens with CAGR and max drawdown and Sharpe. I add it and it boosts almost 2x for 2% of additional drawdown. Sharpe increases by 25%, by 30% even. You see, and an equity curve become even more smooth. That's because I added another strategy that performs best in mean reverting environments on a uncorrelated pair, which is Forex. Okay? So that's basically the idea. That's what hedge funds do. That's what quantitative analysts trying to achieve. That's what I'm doing. But you can't just create a bunch of strategies and put them all together. Because look what happens if I enable all of them. I can do it indefinitely. I can just put more and more strategies. And it makes 800% annualized return and 70% drawdown. Let me tell you why it's a recipe for disaster. First, this all backtested, okay? This edge may not persist when you put strategy live. Drawdown, it says 70%, you can easily hit 100% drawdown. And that means liquidated portfolio, okay? That's why we don't do all of that. First, we need to validate each strategy separately. That's why I have this chart lab thing, okay? That's basically a trading view chart that allows me to review trades that are happening. That helps me understand strategies better, maybe understand where to tweak certain parameters, maybe get another ideas, okay, whatever. So let's test one of the live running strategies, for example, peak momentum Bitcoin. For that, I'll go 1 hour Bitcoin. Yeah, here. And you have all the trades plotted. Let's look at this. I see that it thrives when market is volatile, when we have a big swings, big downtrends, because that's when I have 1, 2, 3, 4 winners in a row. Okay, 3 winners, 2.3 are in a row. Okay, if we go to chop environments like here, I get stopped out. 1, 2. Okay, so that tells me something already. Once I review trades for one specific system, I do this for every other system, and then I'm reviewing how correlated they are. For that, I calculate correlation, okay, and tail risk. That basically means how many positions I have, or how many risk I have in correlated assets at the same point in time, okay? For example, I reviewed peak breakout for Bitcoin 1 hour. Now I'm interested to see what's the correlation with peak breakout for Nasdaq on 30-minute time frame. And I have it calculated using certain formula, and you see it's basically 0. 0 means they're not hedging each other and they're not correlated. They're pretty neutral. Positive 1 means they are correlated. Negative 1 would mean they hedge each other. But you wouldn't want this to be -1 because you wouldn't have any edge. You would just have two positions that cancel each other out. That's why neutral or slightly negative is good. Okay, then we have different type of correlation, tail correlation, which is worst decile portfolio days. Then we have cold crash probability, which also useful, okay? And it helps a lot when diversifying your strategies. You know which one are correlated. For example, peak breakout on gold 2-hour time frame and peak breakout gold on 4-hour time frame. They have 0.3 correlation. This number doesn't seem big, but trust me, if you have, I don't know, if you're doing a prop challenge, for example, and you have 10% max drawdown, you have 2 trades at the same time, which happens every 3rd or 4th trade. When a flash crash or a short squeeze happens, you're basically getting a double loss. You may not expecting that because it's a small number here, but trust me, markets will surprise you. Okay, once you reviewed strategies correlation, and again, these are all backtested results. Ideally, you would need to have this live tested too. That's what I have here. Inside MetaTrader, I've ran this portfolio for a month already, and we can see that current equity is $330 up on a $10,000 portfolio account. That is 3.3% return. If we go to history, go to report and click overview, we had a max 3% drawdown, which is nice, and 20 trades so far, and 2 of them are open. Still not enough data, but 20 trades, 1 month, it had a drawdown and it recovered and it's now in profit. It's a good start. It shows me my process did not let overfitted strategies enter live testing account. That's actually a topic for the next video. So if you're tired of running and wasting time on strategies that don't perform live when they were good on backtest, that video is gonna be useful for you. Okay, back to the backtested portfolio. Here's the thing. I'm still letting my live paper portfolio run these strategies. I would wait for 2 more months before adding real capital to them. Meanwhile, I continue to create new systems, uncorrelated systems, or strategies. Okay, the term is interchangeable. The thing is, you can already achieve these returns without even applying any contextual logic. Okay, like avoid trading on FOMC day or double your risk on FOMC day, because in one scenario it could be too volatile and stop out your systems, and in another case it could be too volatile and it increases the size of your winners. It doesn't have to be FOMC, it can be CPI, wherever. There is a lot of things that can potentially move the market. And once you dive deep into that, once you deterministically use this information and see how it affects your existing system's performance, that's when you find a real edge that can literally boost CAGR twice while keeping drawdown low. I'm not sure if I want to leak anything proprietary. I'd like to keep my edge with me. But I can give you some examples like FOMC, okay? So it helps with your thinking, okay? So it acts as an example, and maybe you use your mind in a creative way. You dive deeper into some topic. You will notice some patterns, most likely, or you not, but you will understand the process. That's what I'm trying to share with you guys. A process of modern retail profitable trader. That's actually a nice way to end this video. Thank you guys, and I'll see you in the next one.